Hello everyone, welcome to our discussion about Chapter 11. We're talking about saving money for retirement, for education. We're going to do this in two parts. This is part one. We'll go over some of the basics and give the introduction, and then we'll wrap up with part two. So the idea is that Congress has determined that saving for retirement, saving for education is something that they want to encourage. And so they have passed laws that have added to the tax code tax benefits, tax advantages, if you will, for this type of savings. But of course, to have those benefits, you have to follow the rules. So there are going to be a myriad of rules that will determine whether or not you receive these tax benefits. Okay, so generally taxation is deferred, and means that is put off. So we're not going to refer to these plans and things as tax-free, but as tax deferred. So we put it off until retirement. So the basic idea is that we put money in, we take a deduction for that now, and when we get it out later in retirement, when our income would theoretically be lower, then we pay the tax at a lower tax rate, because we know that the tax rate depends on our income in the United States. So we're going to talk about both employer-sponsored plans that requires you to be working or self-employed to have that kind of plan, or individual-based plans which doesn't need an employer involved in any of it. So some terminology to make sure you can review this in the text. But annuity is a regular payment on a regular schedule, same time in between each payment over time. Beneficiary is the person who's going to receive the benefits of the plan. So the person who is participating and saving in the retirement plan is the beneficiary, but also we have beneficiaries in case that individual passes away before they receive all of the money out of the plan. Then there would be secondary beneficiaries that we also have to consider in our process. Contributions is putting money into the plan. Distributions is taking it out of the plan. Donor is the person giving it, or putting the money in. All right. If it is tax deferred, it is referred to as qualified. That means that the tax is put off until later. So again, follows the rules in order to do that. And then most of these plans have to involve what's referred to as a trustee who actually holds the contributions. So note that we are not going to talk at all about what is invested in this money. That's a whole separate financial consideration as to what is invested and where it goes. But regardless of what that is, there usually has to be a trustee, and this trustee is going to be someone individual. So outside of the employer, outside of the individual saving for retirement, who kind of watches over the money, make sure that anything going in or out is reported properly, that sort of thing, that there are no incompatible investments. So there is some restrictions, a few restrictions on what you can invest in. Those sort of things are the responsibility of a trustee. Typically a bank or some other financial institution acts as the trustee, okay, for these funds. If you don't establish that trustee, then you're not going to have a qualified retirement plan. It just can't work without a trustee situation. So we said this again, tax deferred does not mean tax free. Okay? Untaxed contributions are taxed when distributed. So if you got a deduction or did not include the money in your income when you put it in the year that you contributed to the plan. That means that when you take it out of the plan later on, it will most likely be taxed. Okay? So it can either be a tax deduction, or it could be just left out of your income in the first place. Okay? Not included in AGI. Both of those are possibilities depending on the type of plan. Okay, so if that's the case, you get a deduction now, taxable later. If you put it in and you don't get a deduction now, then chances are it's not taxable later. So some jargon you probably heard, talked about qualified pension and profit sharing plans, 401k, 403b. Just a little bit, 401k refers to the code section in the Internal Revenue Code that describes it. So you want to find out rules about 401k plans, guess where they are? They're in section 401, those in 403b. 403b is essentially a 401k plan for nonprofits. So for-profit companies set up 401ks, nonprofits, governments set up 403bs. Keogh plans is for self-employed folks, and simplified, as well as simplified employee pensions typically are for small businesses, and simple plans are a little bit step up from a simplified employee pension in terms of the who that can work with and the rules having to do with covering them. Okay, now you've probably heard of pension plans, profit sharing plans. That's the idea where the amount that goes in depends on your profits. That's a profit sharing plan of the company. So a year that the company doesn't make any money, it's not going to contribute to the plan, perhaps, depending on what the rules are. And a pension plan is the situation where there's a promise that they're going to provide a pension later on. Right? We'll talk a little bit about that definition here in a minute. Okay? So, an employer-sponsored retirement plan. This requires an employer to be involved. Okay, there's a benefit to the employer; they get a deduction, and to employees. So, anything the employer puts into the plan is a deduction right now, even though it is not income to the employee. So, obviously, when an employer pays an employee, anything they pay them is a deduction for the employer. Reduces their taxable income. But this adds this new layer in that this is money that is not paid to the employee directly. It's put into a trust, given to a trustee for that employee, for the employee to have later, right, in retirement, but it can still be a deduction now. It is also not compensation employee. Okay, typically it is not reported on the W-2 as income. As that money sits with that trustee and makes money, interest, capital gains, any of that, it is not taxed to the employee or the employer for that matter. Okay? It grows tax. In that sense, it is currently tax deferred, tax-free. Okay, and then it's not taxable until it is withdrawn. Typically, an employee in retirement. That's the idea. So, two types of plans. The one I'm going to define benefit is become very rare, okay? Very complex. Defined benefits, the employer promises to pay out a certain percentage of your salary when you retire. So typically they'll say something like, well, when you retire, we'll give you 60% of the average of your last 3 salaries, the last 3 years of salary. And we'll pay that to you until you die. Okay? That means we've defined the benefit. We've promised a certain amount of money every year. Whether you live to be 65, 70, 100, doesn't matter. The employer promises to meet that obligation. Now, they are required to have certain amount of money set aside to do that, because otherwise they may not be able to meet that obligation. But very complicated, and you have to estimate how much that's going to be, how many of the employees are going to, how long they're going to live, all that kind of thing. So most businesses have moved away from these because there's too much uncertainty, too much is on their shoulders that they can't control. What's things going to be like 20 years from now when I have to pay out this money for retirement? So instead they move to defined contribution plans. This says, this is how much I'm going to put into your plan for you now. It's percentage of what we pay you as salary or some other measure, okay? But how much you will actually have when you get to be 65 or when you retire is, we don't promise anything about that. All we do is promise that we'll put it in for you. You then can invest it typically, although sometimes they'll provide some help in investing it. And if it's a lot, then great when you retire. If it's not, we're not on the hook for it. Okay, so that's why defined contribution plans. 401k plans are defined contribution plans. 403bs are defined contribution plans. A defined benefit plan is referred to as usually as a pension, because there's a promise of a particular amount of money for the long term. Now, both types of plans, if they're employer sponsored, and they're going to be have this special tax situation where the employer gets to deduct the money now, but the employee does not report it as income, then they must meet some fairly stringent rules. First of all, they must be non-discriminatory. That means you cannot choose to just cover the higher paid folks in your company. You have 200 employees, you cannot just choose to cover the top 20 in terms of income, or the head honchos, or those that are have a certain titles or anything like that. If you do that, if you only cover them and not others, if you only do this plan for certain folks, whatever the discrimination is, you will make it not qualified. It means that it will not receive the tax benefit that you want. It has to have minimum vesting rules. So when you put your money in to this trustee for the employee, what happens if they leave the next year? Well, that is determined by vesting rules. If you are vested in the plan, it means if you leave, you quit, you get to take it with you. If you're not vested in the plan, that means the money stays there and goes to the other people in the plan. So there's 10 people in the plan, one of them leaves, the other 9 get to divide up what the one that forfeited was by leaving. Okay, so employers like to have some type of vesting rules that allow you to kind of give incentive for employees to stay. That's part of the reason why they offer these plans, is to get employees to not just keep leaving, right? So if they have a situation where half of it is not available to you if you leave in the first 2 years, that's a vesting rule. Well, the tax law says you can't make that vesting too disadvantageous to the employee. You can't say to them, well, if you leave within the first 5 years, all of it stays with the plan. That would be not an acceptable vesting rule. You have to have a certain minimum vesting rule. Typically, it's like 20% per year you've got to have that is vested at minimum. And you can always have it all the way vested, or you can always vest faster than the rules, but there are minimum rules. Okay? And then you have the situation where either if it's contributory, that means that the employee puts money in and the employer puts money in. If it's non-contributory, only the employer puts money in. The employee does not take money out of their check to put into the plan. In fact, they're not allowed to. Okay? So there's a general limit to how much you can put into a defined contribution plan. And that is $61,000 or 100% compensation. Okay, that seems pretty high. I don't, think you're going to find too many folks that are going to want to have more than that. All right. On the other hand, if it's a defined benefit plan, we don't care about how much you put in right now. We want how much you're trying to provide as far as a benefit later, and the most that you can provide benefits is $245,000 or 100% of the average compensation for the highest 3 years. Okay, and that's the lawyer of those two. Again, that's going to be rare, so you're seldom going to run into that. Far more likely to have defined contribution plan limits. Okay, now a little more specifics about 401k plans. They must meet the non-discrimination rules. It means you have to do a test every year to make sure that that everybody benefits essentially the same, regardless of what their income is. And it can be fairly complicated if you do have some situations where you provide more to one. If you just say everybody gets 5%, okay, then that's obviously not discriminatory. But if you say, for instance, that we are going to match, so if you put in 5%, we'll match that. But if you put in 0, we're going to put in 0. Now you have a challenge, because if some people choose not to put it in, and those are the lower paid folks, and your higher paid folks do choose, then without, you are you're going to be considered discriminatory because you are matching just the high dollar folks because they're the only ones participating. So that can be a problem with a 401k plan. Okay, the most an employee can put in, okay, is $20,500 unless they're over 50, and then they can do some catch up by putting in up to $27,000, okay, an extra $6,500. Keogh plans are for self-employed. They can also be as complicated or as simple as you like. Okay, typically you're going to refer to how much money you make for self-employment as well as your employees and what they make. Okay, again, your maximum is going to be $61K or 100%, just like the overall maximum for these types of plans. Now, a simplified employee pension, very easy to set up. Essentially, okay, you create an individual retirement account, so every employee has a IRA, and the employer puts money into their IRA. Okay, it's going to be 100% vested, meaning if they leave, it all goes with them. They do not put any money into it. So a simplified employee pension is non-contributory, meaning the employee cannot, in fact, put money into the plan. Employer is solely responsible for putting it in. The most they can put in is 25% of compensation, and the most compensation you can consider is $305,000 or $61,000 is the most. All right, and you have to basically cover everybody. Okay, if you have this for one employee, you have to have it for everyone. If you want to put money in for yourself as the self-employed person, you're going to have to do it for all of your employees. The only people you can leave out are ones that have just barely started with your company or have been with us less than a year, or who make very little, meaning you pay them just minimal amounts. Okay, so it's going to have to cover everybody. They're all going to have 100% vesting, and they don't put anything themselves into the plan. Simple plans, okay, is a step up in the sense of complexity, But they tried to make it simple by saying, okay, you can avoid discrimination testing. We're not going to make you look at every year, like with a 401k, at your discrimination. As long as you follow these rules. First of all, okay, you create an IRA or 401k. This is only available for those who have 100 or less employees, by the way. Okay, so this is not for big companies. Employee contributes a percentage of their income. Okay, their maximum is $14,000, $3,000 extra if they're over 50. So that's lower than a 401k. So employees can't save as much with a simple plan. And the employer chooses to either match up to 3%, and they have to do it for everybody. Everybody makes over $5,000, okay? Or they have to not worry about what people put in and just put in 2% for everybody. Okay? So that's their choice between those two. Okay, so they can put in more if they are matching, employees actually do it. But if employees don't respond, then they won't be able to do that. And if employees, we could just do 2% for everyone. So some quick questions. Qualified pensions are either defined benefit or defined contribution. Defined benefit, far less common. Most plans are defined contributions. Okay, employees must make. No, sometimes they don't, and in fact they can't, like in a simplified employee pension. A maximum contribution 401k, okay, for individuals. This is what the individuals can put in, okay, $20,500. Under 50, it's more if you're over 50. Okay, Keogh plan is for self-employed individuals. Yeah, it's true. And simple is for employers with 100 or fewer employees. And you've got to follow those rules we talked about. Okay, that's the employer-sponsored plans. They're common ones. So of course, you got variations on all of those that can be very complicated and so forth. Those are the general principles of the common ones. Okay. Then we move to what is referred to as our individual retirement plans. IRAs, or traditional IRAs, Roth IRAs, two different kinds, individual retirement accounts. These are set up by the individual. Again, you have to have a trustee. You have to set it up with a bank or other financial institution. You can make a contribution of $6,000 or 100% of your compensation. Meaning, if your compensation is less than $6,000, you can't put in the $6,000. Okay, and if it's you're over 50, it bumps up. Whoa, a whole 1,000 to 7,000. So you see how much less this is in terms of what you can save with the tax benefit than employer-sponsored plans. Far more advantageous as far as the amount you can save. Okay, but this situation, you don't need the employer to be part of it. However, if you work for somebody an employer that does have a plan, okay, then you may not be able to deduct all of your contribution. All right, so if you're married and your AGI is over 109,000 and you work for someone who offers a 401k plan, let's say, then your ability to make this deductible contribution is phased out between 109,000 and 129,000. So that is a situation where if you were your AGI and you're married, so your AGI combined, the two of you, is 108,000, then you can go ahead and make a $6,000 deduction to your IRA in addition to whatever you put into your 401k at work. If it's in between that, let's say it's 119,000, okay, you can still put 6,000 in, but you can only deduct 3,000, half of it, because it's been phased out. The other 3,000 would be non-deductible. And now you've got an IRA where you've got to keep track of how much is deductible and how went in as deductible and how much went in as non-deductible, which is a pain in the butt later on, as we'll see when we take the money out. But that's what you've got going, okay? And remember, this is for you participating at work. Your spouse also would have to look at whether they're participating and compare their AGI to the limit and whether or not they can make a deductible contribution.